Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group. I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy. Thanks for our listeners jumping on another call. So I guess the news of the week last week was really the government shutdown ending, maybe taking some pressure off the market on what's next, right? How long could this last? Since that was the longest, I think, in history. So we saw the Russell 2000, that's that small cap index, down about 2%. That was followed by the Nasdaq Composite, really tech driven, down about 0.5%. The S&P was pretty flat. Tech stocks really were where we were seeing the most pressure. That was concerns on some valuation, the AI overbuild, maybe some debt that's starting to be taken on, and maybe a little bit that the Fed was signaling maybe some caution on further rate cuts. So taking the cues off of that, we saw some really all the sectors really negative overall. But we did of those sectors, we saw healthcare up about 4%, continuing with some strong momentum, like kind of what we're talking about in our lunch and learn that we just had. Kind of that third, fourth quarter, where are we at in the markets? What do we thought was going to happen? And we really felt that probably the underperforming sectors might have an opportunity to shine a little bit, where the outperforming sectors might underperform a little bit. And I think that's really what we're seeing right now. But overall, if we jump to commodities, we'll look at the gold futures up about 5% midweek, ending up about 2%, and oil prices little change. Going back to the rates in the Fed, we saw the Treasury yields rise after some weak demand for the 10 and 30-year auction in that auction. We saw the Fed officials adopt maybe a more hawkish tone, possibly pausing, putting maybe a spook or a fear in the market that it's not going to be as accommodating in terms of lowering rates. So the odds of a December rate cut did drop to about 46% on the Fed funds futures. If we look at economic data, we saw the ADP, U.S. firms shedding about 11,000 jobs for the week through late October. The labor market is weakening a little bit, but we don't have all that economic data because remember, the government was shut down and some of those releases we might not ever even have. But we did see small business optimism fall for the second month. Labor quality was really some of the primary concerns with that. Overseas, we saw China industrial production up about 4.9%, where resale sales was a positive 2.9%. That was the slowest pace in over a year. If we look at the Eurozone Q3 GDP, that was a positive 0.2% up. The trade surplus surge on U.S. shipments. And over in the UK, we saw Q3 GDP up 0.1%. That was below some expectations. Now, the week ahead, we're really at the very tail end of earnings season, but it doesn't mean we're over because we have a pretty big name, the largest company out there. I think it still is. That's NVIDIA. They're reporting earnings at the close of the market on Wednesday. So that might set the tone a little bit, especially since we've been getting a bit of a weakness in these large AI names, that whole sector, if you might. We'll get some retail earnings coming out like Home Depot, Target, and Walmart, kind of giving us some clues and ideas of how the consumer, what their appetite is as we go into the holidays. And then we're getting some economic data, some Fed outlook. We'll get the September jobs report that's scheduled for Thursday. And then we'll get some FMOC. The Fed minutes will be released on Wednesday. Some key economic indicators coming out. We'll see some flash PMI numbers to keep an eye out for, setting the tone on the health of the economy, the consumer, maybe certain sectors, existing home sales, revised consumer sentiment figures. Then we'll get into some international. We'll get some flash PMI for the Eurozone and Australia. And then Japan's primary Q3 GDP and CPI update. That'll come out on Thursday. And the UK CPI numbers will come out on Wednesday. Jeremy?
Thanks, Graham. Well, I had a question for you. So it looks like the market's been pulling back just a little bit, maybe since last week. Is that something you were expecting, or what's maybe causing that right now?
Well, kind of what I talked about, and I guess long story short, yes, it was what we're expecting. You got to expect some volatility at these levels. There's certain sides of the market, that AI side, that tech side, that's all channeled towards that AI side. I mean, certain sectors have just gotten over frothy. I mean, and we needed to have some pullback, some digestion. It's okay. But also keep in mind that not everything ran up. I mean, there's more than 493, 490 stocks outside of the Mag 710
Right.
that maybe didn't have big rallies. That, you know, they might not see a correction or a really big pullback. They might be the leaders in the market. What we talked about in that recent lunch and learn, look for the underperformers to maybe start to rise to the surface where the outperformers maybe lag a bit. And I think that's really what we're seeing. And keep in mind, it's never comfortable to go through volatility like this, and it could get worse before it gets better, but it's healthy. You're right. You want to take out some of this froth. Also, one thing for our listeners to keep in mind, we are in the best time of the year. You know, the Santa Claus rally, the end of the year that goes to tax time of the following year. And there's some really good reasons why whatever weakness that we get might get bought up here sooner than later if history proves to be true in this situation where we continue a strong end of the year, a strong first of the year.
Gotcha. Well, Graham, we always appreciate the information and expertise. And thank you to our listeners that check in with us every single week. And we look forward to seeing you next time. Have a great day.
Take care.